Day 25. Uh, 3.9 short sales. Uh, Normally, an investor would first buy a stock later than sell it. With a short sale, the order is reversed. First, you sell, then you buy the shares. In both cases, you begin and end with no shares. A short sale allows investors to profit from a decline in securities price. An investor borrows a share of stock from a broker and sells it. Later, the short seller must purchase a share of the same stock in order to replace the one that was borrowed. This is called covering the short position. Table 3.2 compares stock purchases to short sales. The short seller anticipates the stock price will fall so that the share can be purchased later at a lower price than it initially sold for. If so, the short seller will reap a profit. Short sellers must not only replace the shares but also pay the lender the security any dividends paid in the short sale. In practice, the shares loaned out for a short sale are typically provided by the short seller's brokerage firm, which holds a wide variety of securities of its other investors in street name. That is, the broker holds the shares registered in its own name on behalf of the client. The owner of the shares need not know that the shares have been lent to the short seller. If the owner wishes to sell the shares, the brokerage firm will simply borrow shares from another investor. Then the short sale may have an indefinite term. However, if the brokerage firm cannot locate new shares to replace the ones sold, the short seller will need to repay the loan immediately by purchasing shares in the market and returning them over to the brokerage house to close the loan. Finally, exchange rules requires that proceeds from short sale must be kept on account with the brokers. Uh, finally, the short seller cannot invest these funds to generate income, although large or institutional investors typically will receive some income from the proceeds of short sale being held with the broker. Short sellers are also required to post margin, cash, or collateral with the broker to cover losses should the stock price rise during a short sale. 1 second. Like investors who purchase stock on margin, a short seller must be concerned about margin calls. If the stock price rises, the margin in the account will fall. If margin falls to the maintenance level, the short seller will receive a margin call. Short selling periodically comes under attack, particularly during times of financial stress where share prices fall. The last few years have been no exception to this rule. For example, following the 2008 financial crisis, the SEC voted to restrict short sales in stocks that declined by at least 10% on a given day, allowing them to be shorted on that day and the next only at a price greater than the highest bid prices across national stock markets. The nearby box examines the controversy surrounding short sales in greater detail. 1 second. Let's just read table 3.2. 1 second. Cash flows from purchasing versus short selling shares of stock. Purchase of stock, time, action, buy share. Ending price was driven by initial price. Price is dividend. Yeah, so okay, in a short sale, basically, the profit is equal to the initial price minus, in brackets, ending price plus dividend. So yeah, there's a footnote here. Naked short selling is a variant on conventional short selling. In a naked short, a trader sells shares that have not been yet borrowed, assuming that the shares can be acquired in time to meet any delivery deadline. While naked short selling is prohibited, enforcement has been spotty, as many firms have engaged in it based on their reasonable belief that they will be able to acquire the stock by the time delivery is required. Now, the SEC is requiring that short sellers make firm arrangements for the delivery before engaging in the sale. Example 3.3, short sales. To illustrate the mechanics of short selling, suppose you are bearish, pessimistic on dot bomb stock. Price is $100 per share. You tell your broker to sell short 1,000 shares. The broker borrows 1,000 shares either from another customer's account or from another broker. The $100,000 cash proceeds from the short sale are credited to your account. You tell your broker to sell short 1,000 shares. The broker borrows 1,000 shares either from the customer's account or from another broker. The $100,000 cash proceeds of the short sale are credited to your account. Uh, Suppose the broker has a 50% margin requirement on short sales. This means you must have other cash or securities in your account worth at least $50,000 that can serve as the margin of the short sale. Let's say that you have $50,000 in treasury bills. Your account with the broker after the short sale then will be assets, cash $100,000, T bills $50,000, short position in dot bomb stock 100,000 shares over $100,000, equity $50,000. Your initial percentage margin is the ratio, the equity in the account $50,000, the current value of the shares you borrowed and eventually must return $100,000, equity divided by value of stock over 50.50. Suppose you are right and dot bomb falls to $70 per share. You can now close out your positions at a profit. To cover the short sale, you buy 1,000 shares to replace the ones you borrowed because the shares now sell for $70. The purchase cost only $70,000. Because your account was credited for $100,000 when the shares were borrowed, your profit is $30,000. The profit equals a decline in share price times the number of shares sold short. I'm a little bit confused, so 1 second. My question is, actually, you know what? Forget it. Shares is still the shares, so it's okay. Notice that when buying on margin, you borrow a given amount of dollars from your broker. So the amount of the loan is independent of the share price. In contrast, When short selling, you borrow a number of shares which must be returned. Therefore, when the price the shares changes, the value of the loan also changes. We'll do these Excel ones later. Example 3.4, margin calls on short positions. Suppose the broker has a maintenance margin of 30% on short sales. This means the equity in your account must be at least 30% of the value of your short position at all times. How much can the price of the dot bomb stock rise before you get a margin call? Let P be the price of the dot bomb stock. Then the value of the shares you must pay back is 1000 P, and the equity in your account is 150,000 minus 1000 P. Your short position margin ratio is equity by value of stock 150,000 minus 1000 P divided by 1000 P. The critical value of P is thus equity by value of shares owned equals to 150,000 minus 1000 P by 1000 P equals to 0.3. Yeah, so equity by value of shares owned equals to 150,000 minus 1000 P by 1000 P equals to 0.3, which implies that P equals to $115.38 per share. If the dot bomb stock should rise above $115.38 per share, you will get a margin call, and you will either have to put up additional cash or cover your short position by buying shares to replace the ones borrowed. Short selling under fire. Sarbanes-Oxley. I heard this in Suits, actually, the show. That's pretty interesting. Sarbanes-Oxley. It's pretty interesting. Huh. Short selling comes under fire again. Short selling has long been viewed with suspicion, if not outright hostility. England banned short sales for a good part of the 18th century. Napoleon called short sellers enemies of the state. In the US, short selling was widely viewed as contributing to the market crash in 1929, and in 2008, short sellers were blamed for the collapse of the investment banks Bear Stearns and Lehman Brothers, with share prices of other financial firms tumbling in September 2008. The SEC instituted a temporary ban on short selling of nearly 1,000 of those firms. Similarly, the Financial Services Authority, the financial regulator in the UK, prohibited short sales on about 30 financial companies, and Australia banned shorting altogether. The rationale for these bans is that short sales put downward pressure on share prices that in some cases may be unwarranted. Stories abound of investors who first put on a short sale and then spread negative rumors about the firm to drive down its price. More often, however, shorting is a legitimate bet that a share price is too high and is due to fall. Nevertheless, during the market stresses of late 2008, widespread feeling was that even if short positions were legitimate, regulators should do what they could to prop up the affected institutions. Hostility to short selling may well stem from confusion between bad news and the bearer of that news. Short selling allows investors whose analysis indicate a firm is overpriced to take action on their belief and to profit if they are correct. rather than causing the stock price to fall. Shorts may be anticipating a decline in the stock price. Their sales simply force the market to reflect the deteriorating prospects of troubled firms sooner than it might have otherwise. In other words, short selling is part of that process by which the full range of information and opinion, pessimistic as well as optimistic, is brought to bear on stock prices. For example, short sellers took large negative positions in firms such as WorldCom, Enron, and Tyco even before these firms were exposed by regulators. In fact, one might argue that these emerging short positions helped regulators identify the previously undetected scandals, and in the end, Lehman and Bear Stearns were brought down by their very real losses on their mortgage-related investments, not by unfounded rumors. Academic research supports the conjecture that short sales contribute to efficient price discovery. For example, the greater the demand for shorting a stock, the lower its future return tend to be. Moreover, firms that attack short sellers with threats of legal action or bad publicity tend to have especially poor future returns. Short sale bans may, in the end, be nothing more than an understandable but nevertheless misguided impulse to shoot the messenger. Concept check 3.6. A. Construct the balance sheet if dot bomb in example 3.4 goes up to $110. Let me look at that. 1 second. Okay, let's create the balance sheet right here. Since I don't have a laptop right now, I'll just write it down. Assets and liabilities and owner's equity. If the short position maintenance margin in the dot bomb example is 40%, How far can the stock price rise before the investor gets a margin call? If the short position maintenance margin in the dot bomb example is 40%, how far can the stock price rise before the investor gets a margin call? So to answer this question, should be $150,000 minus 1000p divided by 1000p equals to 0.4. So this means 400p 1400p equals to 150,000. 1212 p equals to 14. So 14 10 0 100 14 times 8 4 times 7 28 298 6 7 so yeah, so 1 0 0 and then 0 0 2 so 0.1 something like that. $107.1 hopefully. Oh yeah, perfect. $107.14. So yeah, that's done. Yeah, I think I'll do 3.10 in the next part. So yeah, thanks.